We are live, I believe. So let's get going for another show here. This is welcome to Selfwealth Live. This is the technical analysis edition here today with Jason McIntosh. Well, it's to my right. Welcome, Jason. How are you today?
Hey, Rog, I'm all good. Good today. Lots of things going on in those charts I'm seeing. So I think we should have, I think we've got a few interesting things to discuss today.
I think so. Yeah, exactly. Especially the last couple of days. To me, the good news for me is that it seems like this 10% drop has sort of stalled a little bit. It's not continued on the last couple of days, so it's sort of stalled there, which is great news. Welcome, Bob. Welcome, Roger. Great name. And welcome to everyone else that's on the show, new or seasoned on our show. We welcome you every week once again. It's appreciate you being here. Obviously, the format is very much the same. So we're going to go through our Aussie market today. We're going to go through the US market, and then we'll go through the Hong Kong market. And then we will answer a couple of general questions, and then we'll go through all your tickers. So if you want to put your tickers in, go for it. We'll try and get to everyone that we can, every single one that we can. All right. So before we go ahead, Jace, let's spend some time on the disclaimer.
Yes, so everything we do today is general commentary only. No personal advice today, general only. And I'm going to quickly put up a disclaimer that we do put up each week, and that just goes through that. Also, I'm not part of Selfwealth. My business is Motion Trader. So you'll see my details at the top with licensing, etc. Beneath there is Selfwealth, licensing, general commentary, all that stuff is in there as well.
Perfect. All right. So as I said, Jace, let's start off with this Aussie market. The good news is this 10% fall that we've had that everyone's talking about. And it's funny how the amount of times you're talking to people and going, well, it looks bad, but technically we're not in some sort of bearish market just yet. But it's stalled. Let's talk about it.
Yeah, well, look, it does look bad when you just call up the chart. This looks it's pretty awful price action. It's actually been one of the ASX 200's most extreme swings in the last decade, and so it's just finished its fourth consecutive week of selling. And at the low, which was on Friday, it was down. It was down close to 10.5% from the all-time high just back this time last month. The last time we saw such a sharp reversal, it was back in January 2022. So we just jump back to there, see what that looked like. And again, that was coming off pretty close to an all-time high. We had a reversal. We saw the ASX 200 reverse by about, I think it was 11.9% over 4 weeks before we then saw that strong rebound back towards the moving averages. And prior to that, you go back to the COVID crash. That was the last time we saw such an abrupt swing from a high. But of course, that continued a whole lot lower. And well, now it's not COVID, is it? It's we probably shouldn't be considering that type of possibility now. Of course, anything can happen, but that's what you call an extreme outlier. Come along, very, very rarely. So this type of reversal that we are seeing, that we have seen over the last 4 weeks, it doesn't come along that often. Maybe a couple of times a decade. Looking at the price action that we have had on the way down, what stands out is how quickly the market cut through these supports. So you can see these blue horizontal lines. So the first line came in at around 8,100. You can see the technical activity that had previously been around that level. Didn't do anything this time round. The next level below that, 7,900. Again, it was an area of quite reasonable technical activity. Didn't muster any type of bounce there. And this is something we've been discussing over the last couple of weeks, and that is that there's been this hesitation of investors to step up and buy the dip. Hence, you've seen these supports just give way so quickly. Rather, it's been a case that every rally, even like a one-day rally, has quickly then been sold. But we are starting to see a bit more of a rebound now. And this is interesting. It's something I discussed in my weekly strategy session last Friday, which I think is worth going through again now. what I want to do, I want to show you an indicator which helps sort of gauge how this could be starting to set up. And what I'm going to do, I'm going to switch over to the All Ordinaries, just because it gives a little bit more. The data on the All Ordinaries goes back a bit further than it does on the ASX 200. And what I've got here, so this is the All Ordinaries. It looks pretty much the same as the ASX 200, slight differences, but not much. And below here, I've put an indicator on. So this indicator is telling us the percentage the market is either above or below the 50-day moving average. So this is you can see this red line. That's the 50-day moving average. When the market is above the moving average, you get a percentage above it. You can see this line in the middle. When it goes below that line in the middle, that's showing it's below the 50-day moving average. And at the on Friday, it got down to around 6%. It was about 6% below the moving average. You can see the 50-day moving average there. That's about 6% below the average. Now, what I've done, I've run this horizontal line beneath the indicator. Well, I've run it across from 6%. You can see where 6% is on the indicator, and I've run it across from there just as a reference point. And I'll show you why I've done that. And it's because 6% often marks an extreme. And I can just compress this a little bit more. And you can see the times that we've come back to 6%. It tends to mark an extreme. Yes, there can be some overshoots. COVID was a big overshoot, but as we discussed, that's an exception. And you can keep coming all the way back. We could go all the way back to 1980, but I haven't run it back that far. I did that in my weekly strategy session. If anyone wants a more detailed view, they can go to YouTube and get that. So just to save us the time of doing all that, I won't do that again today. But yeah, so this 6% mark, it tends to mark an extreme. And now when you go back and you analyse the data, and I've done this all the way back to 1980, which is as far back as my All Ordinaries data goes, there are generally two types of sell-off that result in this condition of the market coming back to or a bit beyond 6%. And so firstly, there's a capitulation sell-off. So you look at a period, say we look at this period like during 2022, you got the capitulation sell-off where the market's been selling off for maybe several months, and it gets down to around this 6% region, and then you get the rebound. So that comes after multiple months of selling. And then the other situation occurs where and of course, that's not what we have now. We don't have multiple months of selling. We've just got 4 weeks. And the other extreme tends to occur when there's been panic selling from a market high, which is more like we have at the moment. And this happens when prices, here's an example from 2022. So market was at an all-time high in January 2022, the All Ordinaries was. Over a short 4 or so week period, we had an extreme sell-off. Market got down around this 6% region, and then from there we had the rebound. I think that's more like what we're seeing now. So even if the current selling was to turn into something more like 2022, and this is in the months ahead, I think the odds still favour some sort of a rebound, a strong rebound back to the moving average. And so just coming back to where we are now. So we've got this short, quick reversal. The price has become stretched. If we look at those historical guides, which I've been talking about, I think the odds favour we do get that sort of strong rebound. And then we assess the price action. It could provide an opportunity to reduce risk if the price action warrants. Need to see what the rebound looks like should that happen. And as I was saying on Friday, like the question, I think, and this is a question I posed to the viewers on Friday when the market was sitting down here at these lows. It's like, should you panic or stick to your plan? And there's no question in my mind. I think sticking to a good plan leads to the best outcomes over time, whereas panicking and quickly selling everything and going to cash, it often leads to disappointment if you're not following your plan, you're just acting emotionally. couldn't discount there's still a bit, the tree gets another shake and the market tests lower again. And we get like a retest of this low, this moving average pull away. But I think the potential for a meaningful rebound is really now starting to open up. It could happen from current levels and keep moving up like it is now, or maybe there's another shakeout, retest low. Maybe then we get that rebound. But I think that meaningful rebound is probably close at hand. I think it's a case of staying cautiously calm, sticking to your plan. I'm happy holding extra cash at this point. I'm not in a hurry to do much buying at the moment, even if there's that prospect of a rebound. It's not a rebound. I'm rushing in to want to just buy up everything. There is the potential. This structural change does look to be occurring. I think this is where that cautiously part comes in. In fact, I'm using this rally at the moment just to lighten my portfolio. So I'm still long the market, but I'm less long. And just before coming on air, another stock just came up in the rebound. I was able to exit out of that. So I continue to trim the sails in this market, not get. I think probably the best, most likely result would be like a large trading range. Maybe I don't think new highs are on the horizon in the near term. At best, I think maybe multi-month consolidation. But we've got to see how this rebound plays out. We need some more price action at the moment. But the interesting thing to take on board is this is an historically stretched level, which often does lead to that rebound. So I think, Rog, it'll be an interesting couple of weeks from here.
Yeah, it's look, at the end of the day, from when I hear you talk about the historical patterns from obviously 1980, it just shows to me once again that a lot of people would never know this or never look at this and take this into account, but being able to see such information can give a little bit more reassurance to try and stick to the plan, right? Whereas most wouldn't have any clue or even know how to look at the past. So it's a great sort of point you bring up with that other indicator down there. Potentially, obviously the past doesn't equal the future. We know that, but the probabilities are that, as you said, there could be a rebound there, and it's good to have that perspective as well, right? And stay and remain calm. So that's fantastic, Jace. Thanks for that. Let's have a look at the US markets then.
Yeah, so we'll start. I'm going to start with the Nasdaq today, and that's because it came to an end of a record run about a week ago. So you notice I've got a different moving average on. I'm using it for this one here. I've got a simple 200-day moving average. Normally I've got the exponential 50 and 100s, but just for this, I've just got the 200-day on because this is a record that was broken. So about a week back, the Nasdaq ended its second longest stretch in history of being above the 200-day moving average. And you can just scroll back a touch. Here it is where it gets above the moving average. And we're talking about closing. So you can see there's a blip here below, but it closes above the 200-day moving average. So this stretch started back in 23 and it's just come to an end. Now, if you're like me, you'd be wondering what the longest stretch was. And longest stretch wasn't that far back in history. You can just quickly jump back and have a brief look at that. That was this period in here from 2016 through to 2018. It was not much longer, but it was a bit longer. That's the longest stretch above the 200-day moving average. Now, important to note, the 200-day moving average isn't a special threshold that automatically leads to lower levels when breached, but it does indicate that there has been. Just jump back to current day. It does indicate that there has been a lot of technical damage done through this sell-off, and it further weakens the chart structure. Ever since that false break that we talked about in the Nasdaq and the S&P 500 4 weeks ago, you can see we'd been talking about this congestion zone consolidation that had been playing out for a few months. Had a break higher, no follow through buying, false break. That was the red caution flag, and you can see why it's worth paying attention to false breaks, and the market's unraveled since. So I think that what we've got now. So there's been as we've discussed, there's been little interest in buying the dip, and that's what's allowed the Nasdaq to quickly make its way back below this 200-day moving average. Now let's jump back over to the S&P 500, and I think it's now inevitable we're going to get that structural change where the 50-day moving average crosses below the 100-day moving average, and then prices below the averages, and then that creates a condition for an ongoing decline. Now, just because the condition for an ongoing decline is present, it doesn't automatically mean that it's going to happen. I think the key now is what the next rally looks like. So we're starting to see a rebound at the moment in the last couple of sessions. But what's it going to look like? Are we going to get some sort of? Is it going to stall after just a couple of days and just track sideways, which creates that vulnerability window when you get that sideways, which can't really muster much of a rally, can't gain traction, and then opens the potential for another leg lower. So we're watching for that. Alternatively, maybe we get that strong V-shaped rally we've seen in the past. I think that's what would be necessary to really disengage that sell cycle. But we don't know. We've got to wait and see what we get. It was interesting. I saw a report last week. It was from the American Association of Individual Investors, and it showed that bearish sentiment was at its 7th highest level since the survey began. So that's a sign of extreme pessimism after this four weeks of selling. It doesn't signal a low because, of course, there are higher levels of. It's the 7th highest, but of course there are 6 higher. So there are other times where the market has sold even more aggressively. So it's not to say it can't get more extreme, but nonetheless, it's at that extreme level. So as I say, it doesn't signal a low, but these are the conditions where notable rebounds form. And like we were talking about the ASX 200 being stretched below the 50-day moving average, the same applies with the S&P 500 and the Nasdaq. As I pointed out last week, we talked about this last week, Rog, this currently isn't a global sell-off. So many indices across Europe and Asia, they remain in positive territory. And let's quickly have a look at an example from Europe. Let's have a look at this. Here's the German DAX index. So there's an all-time high on the 6th of March, and the market yesterday on what's that, Monday trading in Germany, it's just less than 1% below its all-time high. Mm-hmm. So at this point, it's not a global sell-off. It's so this does still remain largely a sell-off in US mega caps and small caps. And of course, the ASX 200, and ASX generally, is being caught up in this volatility. Just coming back, let's bring this back to the S&P 500 for a sec. My focus at this point is on protecting capital. Maybe we'll get, as I was saying earlier with the ASX 200, maybe we get a multi-month period of messy price action where conditions just get harder. It's we just don't know. We've got to see how some more price action develops to help us navigate moving forward into the weeks and months ahead. But for me at the moment, it means holding extra cash, knowing where my exits are, as I've been doing over the last 4 weeks. I've just been selling down stocks as they hit their exit point. Some have been at nice profits too. So it's not just about taking loss, it's also about locking in profits when a winning trade comes back to a designated sell point. And this is where those wide trailing stops come in. And that's my plan for protecting capital, making sure I'm just ready when the next round of opportunities ultimately return. They may return soon. They may be months away. We don't really know. Don't know. So protecting capital at the moment and respecting this what looks like is going to be a structural change in this market where we've gone from prices rising above increasing moving averages to the moving averages now crossing, and prices potentially getting stuck below declining moving averages, which is then a precursor to lower levels. But yeah, as I say, we need to wait and see what this next rebound looks like.
Yeah, and it's interesting you brought up that 200 EMA. I know in the past I've read a lot about big companies, institutions, and all that using the 50 and the 200 EMA as points of reference. Do you do that at all? Do you use those two together?
Well, I use 50 and 100, and this is a simple moving average, not an exponential moving average. They all do similar things, really. It's smoothing the trend. For me, the 200-day just moves a little bit too slowly. I prefer the 50 and the 100. Not to say that there's anything wrong with using a 200. It depends on you, what you're trying to do. What's your time frames that you're trying to work with. It is an interesting situation where the Nasdaq has finished this long run, and when you do compress it up and you look at how this has worked over time, often when the Nasdaq does get below the 200-day moving average, it doesn't snap straight back to an all-time high. There is a period of consolidation. Sometimes it moves into a bearish phase. This is the GFC here, so I'm not predicting that by any stretch. But it's to say, look, when market go from above to below the moving average, it's usually not a case of a quick snap back to new highs. There's often some consolidation. So I think that's the situation we're in now. There is technical damage done. It's going to take time to repair it. It's a matter of, do we get a large trading range over several months, or do we get a rebound and then another round of selling? So we've got plans for both. Wide trailing stops help us stay in the lengthy consolidation. If things turn into a breakdown situation, we get few buy signals and we get more of our exits come into play, and we start to move money into cash, and then that cash sits there and we wait out the bearish phase if that were to happen, and then we're ready for the next round of bullishness when the cycle does turn again. So there's a process, there's a plan. It's not predicting what will happen. It's responding to what does happen with appropriate strategies. And I think that's the way to best keep this as unemotional as possible. It's when you don't know what you're going to do from one day to the next day, and prices they're up, then they're down 5%, and then they rebound. You don't know what you're doing. That's entirely emotional then, and it drives people out of the market. It ruins, destroys capital, destroys their confidence. They say, this isn't for me. That's why I think that planning process, which I go on and on about, do so for a reason, because it's just so important.
Yeah, fair enough. All right, let's move on to the Asian markets then. Hong Kong, start off with.
Yeah, so this is another example of what we've that this is currently not a global sell-off. With look at the Hang Seng, it's trading up around these, still up around these highs. We're starting to see signs that the consolidation is maybe getting underway. So prices are still elevated, but they're not breaking above the high from about a week ago. So I think, given the extent of this rally off the January low, I think we could well and truly see some backing and filling, where prices just chop, let these moving averages catch up, price comes back towards the moving averages. I think that's probably the most likely scenario at this point. But the overall technical backdrop here is positive. And the Hang Seng, we've got this nice series of rising lows and rising highs. Of course, they're the building blocks of an uptrend. If I was long, I'd be happy staying long this way. I wouldn't be looking at what's going on in the US and saying, oh, I should sell my shares in the Hang Seng, because the Hang Seng's not following the US market. It's doing its own thing. And if we do get a bit of a consolidation, maybe that sets up another buying opportunity. Also interesting looking at China, and we're finally getting some momentum coming into this market after several weeks of consolidating along the moving averages. And just on when's this on Friday, we've got this breakout to a 3-month high. And so we've now got this emerging series. Just look at the look at this from the January low. We've got this emerging series of rising lows and rising highs. So that's interesting to see this coming into place in the Chinese market. I think the key now is, can it hold on to these most recent gains? Because the problem we've seen in the in recent months is we get these strong rallies and then they're quickly reversed. Strong rally, quick reversal. So let's just see if over the next maybe week it can hold on to these gains, maybe even push a bit higher. And so I think this week could tell us a lot. I think this is a market worth considering. I think the risk reward here looks. I think the risk reward here looks good. An exit, like if someone were to buy into a Chinese ETF at current levels, a stock could be placed below these recent lows just from earlier in this month. They're about 6% away, and so you got maybe 6% of downside. Upside, of course, is uncapped, is open. So that's why I say I think the risk reward here does look kind of attractive at this point.
Fantastic. All right, let's move on then. I've got a quick general question here via email from Max. Do you always wait for the 150-day moving averages to cross to the downside before selling below the 10 ATR? 10 times ATR.
No, it's for me. The moving averages are a key point of my entry, but they don't figure in my exit. So my exit, I'm using the calculated trailing stop, and I can get situations where the moving averages have crossed to the downside, and the price is below the moving averages, but the trailing stop hasn't hit, and then the stock just continues to build out a trading range, and it will be above and below the moving averages and not trigger a stop. I'm just trying to think. Can I think of an example? So let's just say. So this is CSL. It's been tracking sideways for a long while. I'm going to put a ATR on this. ATR stop. Just need to look at the settings. Yeah, no, it's not going to work on this particular setup. The motion trader trailing stop is different because it's also using a percentage in the calculation. So I can't do the example I was going to do. Yeah, so I'm selling based on where the trailing stop is, not on what the moving averages are doing. So you can get a case where a stock falls rapidly. So we could probably see that here. So here's an example. Well, this is during COVID. It's a case where the stock fell rapidly, but the moving averages didn't actually cross lower for several months. So a trailing stop for me would have exited the position when it was falling rapidly, rather than waiting for the averages to cross sometime later, by which time the stock could be a whole lot lower. So the trailing stop is where. So I always know where I'm getting out with a trailing stop. If you're waiting for moving averages to cross, you don't know where you're getting out. You're waiting and seeing where the averages are. And if the stock's moving quickly, you could be getting out a long way below the moving averages.
All right, fantastic. It's a good way to good response, I think there. All right, I'm gonna ask this question because I don't know. Maybe Roger, you can. The other Roger that's on the other side of the video here. He's saying, what a weak rebound rally this week. Can you smell a dead cat? Do you know what that reference to? Chase?
Yeah. Roger's talking about the dead cat bounce. So the dead cat bounce is a dead cat bounce is a muted bounce which doesn't gain traction. So we described this as we're going through. This would be what a dead cat bounce looks like, something like such. And so the market basically just stabilizes and builds a bit of bit of a platform, but it can't get that leverage off the platform. Meanwhile, the moving averages keep coming down, and this is what creates vulnerability. And then the market becomes susceptible to another break to the downside. And so that's what I don't want to see. I don't want to see this muted recovery, which doesn't gain traction to the upside, and that's what I'm then become focused on and concerned about. We don't have that price action at the moment, and that may not happen. All sorts of things could happen at this point, like these panic sell downs. And we look back through how they've resolved in the past. Some of them, respond like this, and in 2 weeks the market's back up just below its all-time high, and then we get maybe a larger consolidation and then higher levels. So that can happen too. So I don't know which way this is going to go. I think lots of people will probably make predictions about, this is going to happen and that's going to happen, but, nobody knows. So we're just looking for the price action to give us a guide. Is this dip going to be aggressively bought and push prices higher in this sort of manner? Or is it going to be, as Roger noted, the dead cat bounce, where it doesn't bounce, it just hits and then it doesn't really bounce far and just sits flat and becomes vulnerable to a sell-off. So the way to manage that, the each way play is like wide trailing stops. The wide trailing stops gives it every chance to rally back and to maintain a position in stocks which are still holding up reasonably well. But if it continues to deteriorate, well, it also gives us our exit path and a get out. So it's not a hold and hope that things someday go back to their highs. It's a calculated play each way.
Fantastic. All right. So it's a cat that's dead and it's not bouncing anymore, obviously. And
hopefully this cat's got some springy legs still and jumps back up on the ledge.
Hopefully it comes alive again. No animals were hurt talking about this, by the way. All right. Let's get on to some tickers. We're going to start off with a couple from email here. NWL, please. NWL.
This is so like many stocks at the moment, it has the potential that structural change where we can see we're now gone from above to below the averages. The averages are starting to turn lower, not dissimilar to what the ASX 200 looks like. Do we get a bounce? All the same things we were just going through a moment ago. This isn't a dip that I'd want to buy. The dips I want to buy are the ones that come back to rising moving averages, start finding support somewhere between the 50 and 100 day. They're stocks within uptrends, which is just coming back to the averages. This has come below the averages and the averages are now turning. So you can get you often see situations where vulnerability opens up, but it doesn't play out. And that there's a nice strong rally and maybe a range forms. And then later in the year, it's up at new highs. That's still very much a possibility, but I wouldn't be holding a stock like this saying, look, I'm just going to hold come what may because one day it's going to go up to new highs. It might not. I don't know. So I've got my calculated exit level, and if it comes back to that, I'm out. If it stabilizes, great. But we need to see how it plays out. You can see the setup for vulnerability developing. But as I keep saying, vulnerability doesn't necessarily mean it's going to all fall apart. It just means we're in that stage where caution's required, know where our exit points are, and I'm not rushing to buy dips because I don't know how far things can dip.
Okay. Next one, GNP.
Yeah, I've got some of this one myself, and so it's above my wide trailing stop, so that's all good. It's relatively stronger than net wealth, which we just looked at, because you can see it's only just briefly dipped below the moving averages and now starting to push higher again. We don't know how much higher it's going to push, but it is getting that rebound. At this stage, for me, it's a wait and see. It's above the trailing stop. I'm giving it room to move. it's holding up relatively well compared to the broader market. But again, it's not a dip I want to buy. I don't want to buy any of these dips at the moment. It's I'm in a bit of a in a bit of a risk off stage, so I'm reducing risk, not adding to risk. There could be some special situations. Some of the mining stocks look interesting. Some resource plays are looking interesting, but as a general proposition, I'm more scaling back than pushing forward until we get better price action coming across the ASX generally. But the upward trend here still remains intact. So I'd still be, and I'm still giving this the benefit of the doubt with my wide style.
All right. Next one is PPC from Jacques.
Yeah, I've got some of this one too, and I'm still holding my position. It's like the technical structure here is really it's weakened quite a bit. This is a considerable fall below the averages. Is this so? We've got the rally back to the averages going on. Is it going to continue through and get back above the averages, or is it going to stall around the averages and start to lose altitude? At this point, I continue to hold this stock. Not a setup I want to buy. If I was wanting to, if I was looking at like how do I de-risk a portfolio, this is one of those stocks which I could think of maybe exiting on the rebound back to the averages. If like it's my process is if it's above the trailing stop, I'm going to hold it. It also depends where I bought it. If I bought it, like I also use a time exit. So if I'm in at maybe a later point, say I'm in around November, and I'm just a little bit in the red at the moment, I'd probably be now looking to close that. It's about 3 months after I got in. Had I got in around late November, early December, it's coming up to that 3 month point. It's below my entry point, maybe, and I'd use this rebound to take it out of the portfolio, just move a bit of extra money to cash. That said, there's nothing wrong with holding it and using the wide trailing stop. It all depends how people want to play this situation. If people are particularly uncomfortable and want to raise cash, this is a sort of rebound I use to de-risk. I'd sell some stocks into a rebound. I don't like panicking, and this is what I was saying to viewers of the strategy session on Friday. You know, do you panic at the lows, or do you stick to the process? I don't like to panic at the lows, but I am inclined to de-risk into a rebound where I think there's risk of a structural shift generally in the market. If I just want to play it a little bit safer, rebounds, it can be a good way to do it. Much rather sell into a rebound than sell as you're looking for a bid and prices are in a panicked sell-off.
Fair enough. LYC, please.
Yeah, interesting stock, this one. Because this hasn't been following the market down. In fact, it's breaking higher. So you can see this overhead resistance point. I've had marked there for a while. Got above there yesterday, above the moving averages. Moving averages are turning higher again. I think this could well be a large basing structure in place. You can just draw this in. You can see like the lower lows give way to this rounding upward higher lows situation. I think this is worth considering, even in the current environment. So I said there's not much I'm looking to buy. Maybe some mineral plays. This could be one of those exceptions. Yeah, it's like you think like, how do you manage the risk on it? Well, at current levels, a stop maybe below the moving averages, below this low from earlier in the month. Maybe it's around 12%, maybe 12% of risk. Upside is a multiple of that. So I think this would count as being an asymmetric opportunity. Asymmetric in that the potential loss appears to be lower than the possible gain. And we have to use words like potential and possible because we don't know. Don't know how big a loss will be. A stock can also gap lower. So a loss is always a potential loss, even if you've got a stop loss, because you don't know where you're going to get filled. So everything's just, you're just trying to work out your broad parameters. This is where I think my risk is. This is where I think my upside could be. And if your upside is considerably greater than your downside, well, then that's a opportunity to consider. And you're playing odds, and you're playing numbers over time. And when you do that, when you operate within those parameters of upside being greater than downside, it gives you that potential to do well over time. This is one of those scenarios that I think is worth considering.
Okay, fantastic. The next one's from Kirby ADT, please.
Trend is still in place. It's still trending higher. I don't know that I'm keen to buy it at this current stage. It's different to LYC, to Linus, which is sort of like has this large base and has been down and out for quite a while. This one is up near its highs, up near all time highs. So it's coming from a different place. If I had this, I'd very much be holding it. It's recently just broken above this little resistance area. If someone really liked it, it could be bought at current levels, and stop could be reasonably close, just like maybe 10%, just below the 100-day moving average, below these recent lows. So there is a case for buying it. I'm just hesitant to do too much buying at the moment, but saying that, depending on what they're doing and how their operations are working, it could still continue to rise even in a difficult environment. Resource companies can do their own thing at times. So it's certainly a stock I'd want to be holding if I had it.
All right, the next one's from Devender. Analyse GM. I guess that's General Motors in the US, I'm assuming.
Well, let's see. It's got that vulnerability to its technical structure. So the moving averages have crossed, and they're at the moment trending lower. And it's been consolidating below the moving averages. So that doesn't mean it's going to break down. It just means there is some inherent vulnerability in the way that it's structured. But we do get these periods where a stock will pull back. This will be all part of a consolidation. This is where the wide trailing stop comes in. So my wide trailing stop would still be below the market. So I'd be sitting with this if I had it. I wouldn't buy it here, but if I had it, and particularly if I was in from lower levels and I was in profit, I'd still be holding it. Maybe this turns out to be a base before it does rally back above the moving averages. I think maybe the key is which way does it break next? Does it break above the March high, or does it break below the March low? Below the March low, it starts to open up the downside. Below the March high, it starts to put it back within its broader range, and its upside is probably limited while the market is going through this corrective phase. But it seems to be holding reasonably well over the last bit of selling, and this is what we're seeing in the US. We're seeing much of the weaknesses coming from the mega caps, or as they call them, the Magnificent Seven, and the small caps. And there's a big section in the middle, of which GM is one, which it's pulling back, but it doesn't look terrible. So it's an interesting thing that's going on in that US market. So this for me would be, if I had it, I'd keep holding it, but I wouldn't be buying it at the moment.
Okay, next one in the US is IBM. IBM's Hairs.
Yeah, IBM's holding up really well, considering what's been going on in the US markets, in the Nasdaq. It's quite impressive. So I had that gap higher in January, and it's been holding above the gap. Moving averages are still rising. Its price is still above the moving averages. So this is quite different to what we're seeing in stocks like Nvidia and Tesla and Like you look at a stock like what's Apple doing, and Apple's he's like it's breaking down below the moving averages, whereas IBM's not. So if I was in IBM, I would continue holding it. I'd continue holding at this point. Um, Under normal market conditions, where the market was just broadly in an upward trend or maybe trading sideways towards the moving averages, I'd consider this a dip to buy. But we're not in those benign conditions at the moment. There's volatility and there's selling, so I'd be inclined not to buy it. Although it is a on its own merits, it does look like it's a stock to consider. But I'd just be wary of the risk at the moment. If I had it though, I'd be happy holding it.
All right, next
And
one.
here's an example. Here's an example where a stock spent some time consolidating below moving average, which were falling, and then it started to rise. So, as I say, just because something is vulnerable, like if we were looking at IBM at this point, I would have said exactly what I just said about GM. There's a vulnerability to this. The shares are now consolidating below the moving averages, which are turned down. It's not a dip I want to buy, but it doesn't mean it's going to sell off either. We've just got to see, what's going to happen next? Is it going to break the recent lows, or is it going to break the previous high and get back above the moving averages? And as it turned out, it started to break above the previous high, get above the averages. So it neutralizes the sell cycle or the vulnerability that was in place. So vulnerability doesn't mean something's going to turn out poorly. It means be careful because it could. Here's another example back here. I would have said the same thing. We're consolidating below the averages. Be careful, not a dip to buy. And sure enough, this time it sold off. So we look at structure. Structure doesn't tell us what will happen, but it helps us prepare to manage our portfolio. If we get a breakdown, we can sell. If we get a push back above, maybe we can buy. Maybe it's also not a dip to buy. Let the price action play itself out some more. So it's just interesting when we see these patterns reoccur, and the outcomes can be different, and that doesn't matter. It's not about finding this. Like people are always asked after this indicator, which will tell them what will happen every time. There's nothing that's going to do that. It's it's a myth. It doesn't exist. It's about learning how to assess the price action and go with probabilities, and then managing those probabilities with strategies like exit points. That's I think that's the best we can do in these situations.
Yeah, very true. All right, so the next one would be C79. Dennis.
Downtrend. I wouldn't own it. I would have sold it earlier. I would have hit my stop loss on this sell point. Another, like, this is price action. It's so reoccurring. We see the same patterns all the time. So we're talking about all those stocks we've just been through. There's the consolidation below the moving average, which play this game again. Let's see which breaks first. Does the low break? Does the high break? Let's see which way it comes out of this consolidation below the averages and respond accordingly. Breaks to the downside, it's breaking down. Let's get out. There's the risk is it's going to continue to unravel, and that's what's happened. So that would have been my exit at the latest. Would have been on this breakdown. There's nothing here that says come back and buy this stock now. Like this whole way down, people could be going, look, maybe it's basing, maybe the momentum is now subsiding to the downside and it's getting close to an upturn, but none of these pushes to the upside have been able to stick. The moving averages have remained in a downtrend. The price has mostly been below the moving averages. So one pop above the averages doesn't make a new trend. It can just be a part of a short covering rally. So that's why I like to wait for the moving averages actually to cross and the price to stabilize above the moving averages and then break higher. That helps increase my odds of getting on something which is going to rise rather than something which is just going to see some short covering and then fall flat again. It's still a situation to be wary of. It still seems to be in the process of unraveling. I think the odds favour it's going to see lower levels. Now, of course, I can be wrong. It can base at any time. Anything can happen. But unfortunately for this stock, for those holding it, the path of least resistance does remain to the downside.
All right. Next one's a question around a SPR and RMS merger. What's your thoughts on that? I guess we'll go through both of them. Yeah.
SPR,
Yep.
Spartan Resources, and RMS, is it?
Yep. Merger.
Yeah, so that's Ramulus Resources. So Ramulus is doing the they call it a merger, but it's really Ramulus is leading the charge and bringing Spartan into it. So yeah, I unfortunately am a Ramulus shareholder, not a Spartan shareholder. So Ramulus's shares have fallen. It's one of the few gold stocks to fall in the last couple of weeks. And that will happen. That's the thing with gold stocks. You can be right on the metal, but you can be wrong on the company. That's why I'd prefer to spread risk across a range of gold plays rather than just go, I think gold's going up. This is my favourite gold stock. I'm all in on that one, because if you pick the wrong stock, it could be entirely disappointing. And fortunately, Ramulus isn't my only gold play. So if I was in Spartan, I would certainly be I'd keep holding it. Like, it's breaking to the upside. It's broken out of this range. Look, it's a takeover now, so there's parameters around it, like how much further it's going to go unless a bidding war were to start. But I'm not sure on this, but I think Ramulus already has. I think they're mopping up a part of the shareholding they don't already own. I think they already own a large stake in it. So maybe there won't. Maybe that means there can't be a bidding war, but I don't know. You've got to check all the fundamental stuff for yourself. But I think the answer to the question is, what would I do with SPR? If I had it, I'd hold it and let it lead into the takeover. With RMS, jump over to that. And so what's happened? They announced a mine expansion, and this takeover. It was a mine expansion which saw the share price fall. Saw something similar with Evolution. They were doing something with their Canadian with an operation they have in Canada, and it caused. I'll just show you. It was let's jump over. It's like. There might have been, I think it was this face here. Like, something happened with their Canadian, a big mine they have in Canada. It was in a positive gold price environment, and the price gapped lower on that, and it took some time to stabilise. And then that broader gold trend started to kick back in, and prices started to rise again. So I think something similar might happen with Ramulus. There's near-term negativity around an announcement of the potential of capital being raising. Maybe there's a potential capital raising due to mine expansion, and people don't like that, and they just go sell. But if the underlying company is strong, which it appears to be, and we're in a positive gold environment, I think the odds would favour this sell-off would stabilise, and prices should start to re-engage to the upside. I wouldn't buy this dip nonetheless, because I don't know that's going to happen. If it continues to sell down, I'll have to close my position. Go, oh well, it's a gold stock that's going to do its own thing. But at this point, I'm still holding my position. I bought mine when it broke higher a month or so ago. Initially went well, and then we got that surprise move down. But the broad upward trend is still in play, and they're taking over another gold stock. So it seems to be a company which does have access to plenty of gold, which should ultimately be a good thing in a rising gold environment. But at the end, I'll have to respect the price action. If it keeps selling off, it would have to go.
Yeah, fair enough. There's a lot of questions around gold at the moment, actually. Obviously, it's a rising market. So we might just do one more of gold, AUE, and then I'll ask a question off the back of that further down, just because I think it's a good question.
Yeah, it's you wouldn't know this is a gold stock by the price action. Look, we've got some signs of rising lows and rising highs, a little bit like the Chinese stock market. It's only like, I'm not trying to correlate the two, but rising lows and rising highs, but it's only over like a couple of months. So there's this potential maybe this is starting to turn around, but it's a little bit early for me. The moving averages haven't swung yet. I'd be inclined to leave it alone. It's these lower price stocks move a large percentage as well when they move about. So to buy any at this point, it's looking like probably looking at like a 22 or to 26% stop just to get below these recent lows. I think that's where a stop would need to be if buying at current levels. So I'd be, and there's not enough for me to justify that. I don't have enough of an upward trend to justify that. So I'd leave it alone. We've still got these declining averages. Prices mostly been below the averages. The one bright spot is those rising highs. So an interesting one to watch, one that could develop into something. But yeah, for me, it's probably just a little bit early. I'd probably rather pay a bit more and get in later, maybe at a higher level. That said, if we come in next week and it's trading at 44 cents, I'm going to say, well, look, it's run too fast and it's too hard to get in. So it's hard. We don't always get the ideal setups into stocks, and sometimes we miss stocks, and that's just the way it's going to be, and that's okay. It's I want to play the setup where I think the probability and the risk reward is in my favour, and if I just don't get that, well, sometimes I'll just walk away and I'll look later on and went, oh, look, that worked out well, but I'm happy I didn't play it, because if I play those situations over and over again, I probably come out behind, even though one might go my way or go upwards. So yeah, not just for now for me.
All right, actually, there's a related question here from Kirby. So, when you get a buy signal for commodities or metal companies, do you consider the price action of the underlying physical before making a decision?
No, and I know that because I can think of like some gold, there's some, like I've got some stocks in my portfolio now which I didn't know what their underlying commodity was when I bought them. I just bought them based on the signal. The setup looked good. The overall structure looked good. And I didn't worry myself so much about, okay, what are they mining, and then making a view on that. It's for me with the signals, particularly when I'm taking many relatively small trades. I'm usually happy just to go off the individual stock, rather than have to worry about, okay, what's their underlying product doing. You can get situations where the gold market can be flat, but a gold stock can still do well if there's something special about what they're doing. So I'd go off the individual price action, not so much the metal. That said, if I know it's a gold stock and I know gold has just broken down, well, I might then be inclined to say, look, I'm just going to watch this for a few days and see whether it falls into sync with the gold price. But generally speaking, no, I'm really just focused on the individual company.
All right, great. So going forward, I reckon here's a challenge for you, Jace. We've got about 14 or 15 tickers to get through. If we do, you got about a minute each, right? So,
Okay.
It's a quick thing. I've got a mental blank there, but let's get on. CHN from Albert. Quick fire. That's what I was looking for. Quick fire.
Quick fire it is. Is there a base forming? It looks interesting. This could be a big base. It's gone from below to above. It's consolidating along the moving averages. I think a break above these recent highs would be a signal to buy. Manage risk accordingly. But this looks really interesting. It hasn't quite broken up yet. Could preempt it. Could buy today with a stop below the recent low. That's probably not too big a percentage. I won't work it out because I've got 1 minute, but it looks reasonable. Could be bought now. Could be bought on breakout. Yeah, this is going to be an interesting one to watch.
Next one's SOM. You can take a bit more than a minute if you like. It's up to the viewers if they want to
Oh
stay.
no, it'll take
They
too
want
long.
to stay for an hour and a half.
We'll be here all afternoon. I've got some of this myself, and it's what's gone from like a strong advance and a reasonable pullback to the moving averages. It's still a pullback to the moving averages. It hasn't broken down. It's still got that that emerging upward momentum to it. It's struggling in the current environment. Is this pullback? Well, this pullback is probably largely to do with the environment rather than like the market environment rather than the stock itself. I'm still holding mine at this point. If we break much more below the 100-day moving average, it'll probably be a sell for me. It'll be closing in on its motion trader stop as well. I don't want to buy this dip at the moment. Like I said, there's not too many dips I'm looking to buy just yet. But this could, it's still got the sort of structure that could still resolve to the upside. So at the moment, I'm giving it the benefit of the doubt.
Beautiful. All right, next one's from Elizabeth. CU6.
So this was a motion trader stock. I had it myself. It was an exit. It was a motion trader exit, an exit for me. Must have been in December when it's just started to break down. See below the moving averages, consolidated, then broke to the downside. So it was a sell. It's a stock I did own, but I don't own. So I'm out of it, and because of the structural change and hitting the trailing stop. Nothing here says that there's a low in place. The momentum is still to the downside. We've got a 1 day bounce, but that doesn't make a low. Like now, I'm saying momentum's to the downside. 1 day this will probably bounce. Is it today? It could be, but I don't know. So I've just got to go with the underlying momentum, which is to the downside. So it's not a stock I'd want to own. If I was stuck in it, I'd be looking at the if we do get a rebound in the market over the next week or two or whatever it may be, I'd probably look to sell a rally back towards the moving averages. But then, of course, at some point, if it does rally, you're managing risk. It's like, is it hold and hope that it is going to go up, or is it like I just can't take the risk that it's going to halve again, and in 6 months' time it's down at $1 or more? If you can't accept that, if it's untenable to be in a position where the stock's trading at $1 or lower, I think it's important to work out, okay, what am I going to do to ensure that doesn't happen? And that has to be exit a stock which is trending lower rather than holding and hoping it's going to go back up. People get stuck in these situations all the time. I think that's why we've got to have that clear-cut clinical exit point so we're out before we're in this awful position where we're saying, it's fallen so far, I just don't want to sell now because I'm worried it's going to rally. To that, I'd say, okay, if it rallies, it's going to be frustrating and disappointing. What's going to be more disappointing, missing out on a rally or holding if it's down another 50% or more? And everyone's going to have their own answer to that. There's not one answer. I know what my answer is. This is untenable for me down here, so I've got to get out. But someone else might say, look, I'm cool with that. I'm just going to hang in there because I'm confident this stock's going to come good. And like, okay, that's for you. That's for you. But got to be careful with downside. If you let too many stocks run away from you on the downside and you end up with a few star entertainments, it really does destroy performance. So be careful in these situations.
All right, WDS.
Downtrend still in play. It's I'd have to leave it alone. There've been several times where it looked like a low could be in place, but it hasn't been, and it keeps giving ground. Moving averages are trending lower. Prices below the moving averages. Just a couple of days ago, they were at a multi-year low. The oil price looks tenuous. It wasn't able to hold on to a rally a month or so ago. It looks like there's underlying weakness in the oil price that set us on a large support level. I've been saying in my weekly strategy sessions, I'm just happy to just leave the oil sector alone at the moment. I think it's a difficult place, and I don't think there's a good play there. So I'd be leaving Woodside alone.
All right, the next one's from Earl, KPG. Both still a buy after big runs. Both motion trader winners. Thanks, Jason.
That's good. I'm glad we're on a couple of winners. Yeah, I'm on this one too. I've had it for a while. I've actually had it twice. My initial I bought, so it's been in motion. There's been a couple of motion trader good wins in this. So the first one was back in 2020, where this blue circle is. So I rode that uptrend, got out when the trailing stop hit, went through a year of consolidation, broke higher again, and we had another great trend out of it. Trend's still in place. I'm still long. Wide trailing stop. See what happens. It's not a stock. I haven't averaged down. I haven't sold. Haven't scaled out of this position as yet. I'm not planning on doing so in the near term. It's just the trend's in place. I'll let it keep running until the stop is hit. Again, I'm not looking to buy too much at the moment. I wouldn't be buying this dip just in the current environment. Rog, what was the other one?
GDG.
And I think I've got this one too. There's a couple of stocks in the G's which I get mixed up with sometimes, but I'm pretty sure I've got this one. And it's a stock I'd be holding. Uptrend still in place. It's come back to the averages. It's done that before. Has these pullbacks. Nothing here to me says sell. It has had a big run. At some point, there is going to be a correction or at least a lengthy consolidation, but I don't know where that's going to come from. Is it now or is it later? For me, the best way to manage this is just that wide trailing stop, so I don't have to second guess where it's going to stop. If I was in early, I probably wasn't in as early as when it first triggered a signal, but it's up maybe. Let me just work that out. Like possibly 220%. Usually, once stocks get above 300%, sometimes I just scale out a little bit if there's reasons, if I believe there's reasons to do so. But at a couple 100%, I'd usually just be letting that roll because it hasn't become an overly large part of the portfolio just due to its successive gains. Once a stock becomes a bigger percentage within the portfolio, it creates its own volatility when it moves around. So just to tap down the potential of volatility, sometimes I might just take a bit off the top. But yeah, this one here, I'd be happy. I am happy holding.
All right, the next one's from Jag G. Let's have a look at PAR.
Yeah, look, there's it's a stock that was really starting to shape up nicely, but it's been caught up in this recent volatility. The potential for this to turn into emerging upside is it's still there. It hasn't severed the upward trend, although it has done some technical damage. If I were in this one, which I'm not, I'd be working on a trailing stop. I think that's what I'd have to do with this one because you don't want these situations like you don't want to see CU6 to develop where it keeps eroding and you keep holding and going, oh, when's it going to turn up? And it doesn't turn up. And then you're going, well, when am I going to sell? And the percentages become a lot larger. I'd have a line in the sand. Maybe it's around 30, 35, 36 cents thereabouts. Just from like looking at this pullback, it's like I give it plenty of room, but if it can't get a foothold soon, I'd probably have to wind it up and just protect the capital because I don't want to be down here at 24 cents or 15 cents going, what am I going to do now? So if it hits my exit point and then rebounds, so be it. We've discussed that. I can't tolerate a situation where it's down in the dumps and I've just held the whole way down. So it could re-engage from here, but it really does need to get a foothold pretty soon.
All right, AMI.
Yeah, again, resources is doing its own thing. I'd very much be holding onto this one. It's breaking out of this. You see this trading range. It's coming out of. With what's about 6 months, 6 months of sideways price action, breakout, retest the breakout, rallying again. So, and it's coming, we've had this big bearish period, basing period, an initial rally, a consolidation. It's one of those ones which does have the potential to do its own thing and keep rising. If we get some serious market volatility, it's going to most likely get caught up in it. But who knows what we're going to get? We've been through the ASX and things that could happen. At this point, this one's holding up well. I'd be happy holding it. It's you can also make a case for buying it if you wanted to take on that risk. If you like what they're doing, stops back probably below the February low. We could see this continue to move higher.
Full EIQ.
Yeah, it's not a dissimilar price chart to what we just looked at, in that we've got a consolidation, a breakout. This was a pretty harsh retest. Came back within the range. So that probably would have been a trigger to sell had someone bought this initial breakout. They could have well been stopped out there, but then it's come, and that's probably tied up with the market selling generally. It's probably less volume in this stock, so it moves. It's probably more inclined to have those sharper swings. But then that dip's been bought and it's pushed prices right back up. So it shows there's that underlying interest in buying this stock and picking it up on down days. If I had it, I'd want to keep holding it. There's even a case for buying it at current levels, stop below the March low. Had to work out what the percentage on that is, but I think there's merit here. This is a stock which, like we just looked at the previous one, we could see this continue moving higher.
Okay, MAU.
There's another gold-related stock. Again, it's doing its own thing. If I had it, I'd be holding it. I probably wouldn't be buying it at this point, because unlike the last two stocks I've looked at, it hasn't just broken out of a nice clear pattern. Got these rising lows, which is good. A little bit stretched above the averages. Maybe if we got some consolidation as the averages catch up, there could be another buying point. But if I had it, happy holding it.
All right, fantastic. Lloyd asked for HLI.
Trend still in place. Happy holding it. Don't want to buy it. This is a sharpish move back, and it has become quite stretched above the 50-day moving average. Maybe there's a period of consolidation which is going to play out. At this stage, I'd be happy holding it with my wide stop and see what happens. See if it does start to consolidate, form a new base at higher levels, and then from there, maybe it can break higher. The trend is still in play. It's been generally trending higher for a while, although it has been some sharp setbacks along the way. But broadly, the trend is still in place. Wide trailing stop. See what happens.
All right, next one's from AJS. TLX.
Trend still in place. Pull back to the moving average. I'd be happy holding it. I'd know where my exit is. I'd work out my trailing stop somewhere below the 100-day moving average. It's holding up well in this current environment, and it's an example that not everything everywhere is selling off. It's the headlines are all around the Magnificent Seven, but they're not the market. They're 7 stocks. Small caps are also having their problems, but it's not everything everywhere selling off. So look at the price action of your individual stocks rather than just reading the headlines and thinking, well, everything's doing the same thing, because as you can see with this stock, it's not. So I'd be happy holding.
Okay, fantastic. ACF.
Started to break higher in February, but it's now that breakout has failed. You can just draw the breakout point here. So there's our breakout. Breakout failed. We're now back below the moving averages. So it's This is, for me, this is a motion trader stock. It's still above its stop loss. For me, this is in neutral territory at the moment. It's kind of back within the bounds of this this range, which it's been in for several months. It's below the averages, so it does open up vulnerability. So if it were to break below the February low, that opens up, I think that would open up downside. But if it can hold here, may find that it starts to push higher again. So at the moment, it's just neutral. If I had it, I'd be happy giving it a bit more time, but I certainly wouldn't buy it at this point.
All right. MMS.
And remember, this is also a stock coming off a large upward phase. This could still just be part of a large ongoing correction. It's like sometimes we get early breakouts from corrective periods which don't kick on and they come back and the consolidation continues. It just could be where we are with ACF. Sorry, Rog, what was that?
MMS.
No. It's like we've discussed a couple of stocks which have been in this downward trending phase, and the risk is that they continue falling. So you could just go back and re-listen to what I said then, so I don't repeat it all, because I'd say the same thing. It's like, I don't want to be down here. It might not get down here, but what if it does? I want to know my exit point. I'm not in it. I wouldn't be in it because my exit would have triggered some months ago. And this is the thing why I wait for moving averages to cross. So we got this potential of a turnaround, this nice sharp rally. Looks like it was news-based. News-based rallies can be dubious because they don't always hold. But then the key was then it had to stabilise above the moving averages and get some sideways price action, and then that creates conditions for a potential turn higher. But we didn't get that. The rally was quickly sold into and went down at lows. So the rallies are being sold. That's not a positive sign. It's it's a stock I wouldn't want to be looking at each day in the portfolio.
All right. I think that's it, Jace. You've done a great job. So maybe you can help us out with this question, with this statement here, and let me know this reference, similar to the dead cat bounce one, or Kirby can as well. Be watching for an O'Neill follow through the day on the rebound. Until then, it is suspect.
O'Neill. So O'Neill, he was a technical guy from I think maybe the 60s or so. He's got some good books. There's some good books by O'Neill. He does. I'm not an expert on O'Neill's strategies, but he does work on breakouts and follow through buying follow after a breakout, which is kind of what I talk about a bit as well. We're just talking about that last stock. It broke out above the moving averages. I wanted to see some sideways price action, then another break. So that's kind of, I guess, in a sense, follow through momentum. So we get a break. We see the break stick, then we see it break again and go, okay, it's go time. Let's run with this. It helps avoid the false breaks where you get an initial punch high that doesn't stick. So hopefully I've kind of got the O'Neill slant right around that. But yeah, it's lots of interesting stuff to be across and learn about and read about. And you find that a lot of these, you can get all these greats from years gone by, and there'll be lots of crossover between what they do. They won't have exactly the same methods, but there'll be crossover. And a lot of it involves going with strength. If something's running, let it keep running. Buy what's working, avoid what's not. Cut what's losing. It's they're those time-honoured strategies that I think if you take on board, it can really help stabilise your portfolio during the volatile times and help you excel when we're in the in those quietly advancing upward trends.
Yeah, good. And it's always great to hear, obviously, people that have done it using systems that have crossover, done it over many, many years. Once again, leaning on these people and knowing that, knowing that you're in the right side of the educational field versus a lot of the other stuff that's out there, which can really, really confuse a lot of people, right? So we're not here to confuse anyone. Hopefully we are making a lot of sense to our viewers. It's been great. Another great show, Jay. So thank you very much. Don't forget to like and subscribe and to our channel, obviously, to the Selfwealth channel. There's some links below if you wanted to try Selfwealth out. If you're not a client, obviously, you can always hit me up with any questions. Just send an email to support@selfwealth.com.au and attention it to me. Obviously, if you want to know more about Jason, you can go over to motiontrader.com.au. There's a link there for his trial service as well. A great service that it is. But other than that, look, we look forward to doing this all next week and seeing how the markets are flying by then. So thank you, everyone. And thanks again, Jace.
Thanks, Rog. Thanks, everyone, for joining. It's been fun. Yeah, look forward to next week.
All right, great. Take care, everyone.